Hello, everyone. Thank you for joining us today. It's great to have so many of you listening live. I'm Rob Hansen with Locumstory.com, an educational website about the ins and outs of locum tenens. If you have locums questions, Locumstory.com has tons of resources you can check out. Today, we're really excited to learn from Dr. Jim Dahle, a practicing emergency physician and founder of the White Coat Investor. He's going to dive into how financial health can impact our physical health. But before we get started, I just wanted to run through a few housekeeping items. As a reminder, you can't be seen or heard. However, you can ask questions, any questions you have for Dr. Dahle, by clicking on the Q&A feature at the bottom of your screen. We'll be reviewing those questions throughout the discussion, and he'll answer a few live after his presentation, so please ask away. For some reason you're having technical difficulties, please just log out and log back in. Lastly, we're recording this webinar, and we'll publish it as quickly as we can after we finish. You'll receive an email with a link to this session. I think that's about it for housekeeping. So Dr. Dahle, it's all you.
All right, thanks for having me. It's wonderful to be here, and thank you to Locumstory.com for sponsoring this talk. I'm glad all of you are here as well. Hopefully we have a great discussion and learn some new things today. The talk I've got planned today is called How Finances Can Impact Health and Wellness. And you can see a picture there. This is me. This is what I did this spring. I spent 3.5 weeks in the Grand Canyon, and I told people I was going to the Grand Canyon. The first question they usually asked was, "Are you going rim to rim?" I said, "No, I'm going end to end, 280 miles on the Colorado River." And at times it got a little bit spicy, such as this shot taken in one of the rapids late in the trip. But today we're going to be talking about a bunch of fun stuff. Before we get into it, I think we need to go through a little bit of preliminary information. First is probably why you should listen to the rest of this talk. Let me tell you a little bit about my story, who I am, why I do this. I discovered about halfway through residency, despite having no interest in finance or business or investing as an undergrad or medical student, I realized about halfway through residency that I'd been ripped off by about every kind of financial professional there was. A recruiter, a mortgage lender twice, an insurance agent, a financial advisor, a realtor, you name it, I'd been ripped off. And I got sick of it. So I decided I better start learning this finance stuff so that would quit happening. And after a few years of doing that, reading books and participating in internet forums and reading blogs, I realized I was doing a lot more teaching than learning and got sick of typing the same thing over and over again into the internet. So I started a blog called The White Coat Investor in 2011. And it grew pretty quickly into the most widely read physician-specific finance and investing website in the world. And was subsequently followed by a book. There's now 3 books, by a podcast. There's now 2 podcasts, by a live conference, by an online course. I think we now have 5 or 6 online courses. And it's really grown into a pretty cool little business. We've got about 12 people working here at the White Coat Investor. But perhaps the biggest benefit of learning all this stuff early in my career is my wife and I were able to apply it. And so we hit the ground running when I became an attending, and rapidly grew our wealth. And by the time I was 38 and she was 35, we were pleased to see we were millionaires. Just a few years later, we reached financial independence and basically made work optional. Now that was 4 years ago. I'm obviously still working, and but I'm working on my own terms. I'm working because I want to do it, and I'm only doing what I want to do. And one of those things is talking to you today about personal finance and investing. But this is the real reason that you should be interested in finances. This is, no kidding, a screenshot of my Am I On for August. That's my schedule. That's my clinical schedule next month, right? You'll see a couple of things about it that are pretty cool. One, there aren't that many shifts on it. And so I get to choose how much I work. And that's something that most doctors will do. If you survey doctors, about a third of them will tell you if they had enough money, they wouldn't work at all. But about 55% of them would tell you they will just work less if they had enough money. And this is what working less can look like. You just work fewer shifts. It's great because you don't need the money. The other cool thing about that schedule, I'm an emergency physician, you'll notice there's no night shifts on it. And one of the best parts about becoming financially independent and having my financial ducks in a row was I was able to drop night shifts. Because after about 10 years, I'll tell you what, it wasn't fun to be up at 3 o'clock in the morning anymore. All right, I should make a few disclosures and disclaimers as well. I have a for-profit business called the White Coat Investor. The website is totally free to you, but I do sell ads on it. I'm really big about disclosing our financial conflicts of interest there, and any I have in this talk, I'll also disclose. But if you buy my stuff, if you come to my conference or you buy our online course or the books I wrote, obviously I make money. But I'm an emergency physician. I'm not a licensed accountant, attorney, or financial advisor. And so this talk is for your entertainment and general information. It's not personal, specific, formal accounting, legal, or financial advice. And also, I think anytime we talk about finances in the medical community, it's important for us to put this caveat up there. Money mostly doesn't make you any happier. You didn't go into medicine primarily for the money, and neither did I. But if you ignore it, it can make your life really miserable. Money is a lot like oxygen that way. When you have enough, you never think about it. When you don't have enough, it's all you can think about. So it's okay to talk about money and realize that financial literacy among doctors is affecting patient care. It really is. Okay, here's what we're going to talk about today. We're going to talk about our health and our finances. We're going to talk about how financial planning prevents and treats burnout. We're going to talk about how financial literacy matters, how it's really your second job. We'll talk about playing offense and defense. We're going to talk about the benefits of a written financial plan. Then we're going to talk about physician retirement. I'm going to give you some good news about it. I'm going to give you some bad news about it. The WCI Wealth Plan will be our final subject this, I guess, afternoon in most places. I suppose if you're on the West Coast, it's still morning. But please put in your questions as we go along. I'm planning on a 45 to 50-minute presentation. And after that, taking questions for 10 or 15 minutes. So please get your questions in throughout the presentation. All right, number one. Here's another shot, this one from one of the most famous rapids in the Grand Canyon. Really fun rapid. Almost no risk to it at all, but these great big, huge waves all the way down. It's called Hermit. But we're going to use that picture to talk about your health and your finances. Financial stress is a big deal. A lot of people don't realize how much it affects your health. It can cause migraines. It can lead to cardiovascular disease. It can lead to absences from work, insomnia, anxiety, depression. It can affect your GI tract. And obviously, it can cause some people to gain weight and have trouble with their memory and their concentration. Take a look at this study from 2016. This is an association between rotating shift work and the risk of coronary heart disease among women. Basically, they showed if you work nights, you're 15 to 18% more likely to die from coronary heart disease. It's basically a cardiac risk factor. It's like having high blood pressure or diabetes or high cholesterol. A separate study in the British Medical Journal suggested that in Canada, 7% of MIs, 7.3% of all coronary events, and 1.6% of strokes could be attributed to working shifts. Now, many of you out there are shift workers, especially if you're on this talk at noon, right? It's because you're a shift worker. You got an evening shift tonight or a night shift tonight or last night or whatever. But obviously, having your finances set up such that you don't have to do this is a great way that your finances can improve your health. Here's another interesting study. It turns out that wealth actually affects your health. Okay, it adds 9 more healthy years of life, not necessarily 9 more years of life, but 9 more years where you are actually healthy. That's a life free from disability and pain. They looked at this across the UK and the US and controlled for a bunch of other social and economic factors. But it's true, being wealthy does make you healthier. Here's a real life example I got by, I think this was posted on the WCI forum last week. Basically, it's an example of a couple that's really struggling due to some partial financial issues. She said, "Hi, I'm a wife of a physician. I was hoping to get some advice and perspective on how I can help my husband. I think he's burned out. He's working from 7 a.m. to 7 to 8 p.m. daily, plus spends about 8 hours on another full day every weekend. We went on vacation. He was working every day of it for several hours to catch up on paperwork and is often 30 plus charts behind. I keep asking him to cut back at work, but he says it's not linear. And if he cuts back a little, his income will drop by a lot. We've been together since the first year of medical school, so I've seen it all. But all this time, we had hoped that once the next step in training comes, it will be easier. And here we are, and he is miserable. I'm miserable. We're not spending any quality time together as he wants to withdraw and scroll through his phone a lot and is pretty tired and irritable a lot. I don't know what to do because I think it's all due to crazy hours and I love him and want to help, but don't know how." This is a problem that can be solved with financial planning. All right, so pearl number 2, financial planning prevents burnout. So which doctors are most burned out? Well, this is the most recent study on Medscape. Believe it or not, the urologists, who always seem so happy to me, came in at the top of this list. Neurology, nephrology, endocrinology, family medicine, radiology, OBGYN, and rheumatology, all near the top, which is kind of a change from the way studies have been in the past. In the past, it's always critical care and emergency medicine at the top. But lately, the specialties that are most burned out have really been mixing around a little bit more in the surveys. But what financial planning does is it helps you to align your values with both your time and your money. So now you're spending both your time and your money on the stuff you actually care about. And that makes you happier. It makes you less burned out. It also makes you financially independent earlier. I mentioned at the beginning of the talk some of the benefits of financial independence. One of the biggest ones being you are in control of your work. And you get to work as much or as little as you like. You get to determine what that work looks like. And it turns out the medicine is way more fun when you don't have to practice it. Financial planning also helps you to decrease your fixed expenses. It helps you to do things like pay off your student loans, pay off your mortgages, so that you can actually live on less money. It gives you what is called, in polite society, walkaway money, sometimes also called FU money. But it basically gives you the ability to tell an administrator that they're not going to affect how you practice, they're not going to control your life, and you can walk away at any time. But perhaps most importantly, financial planning allows you to consider some lifestyle improving options that can really be used to help burnout. You can work fewer hours, you can work fewer evenings, nights, weekends, or holidays. You can buy your way out of call, you can change jobs, you can even leave the profession and do a different one altogether. All right, so let's talk a little bit about financial literacy. This is a picture of my daughter and I. This is in the Cirque of the Towers on a peak called Pingora in the Wind Rivers. Medical school and residency and fellowship made you a clinical expert. But what they did not do is give you any business training, any personal finance or investment training. And then you came out and you were asked to do this second job as a pension fund manager. That's right. In our 401k world, you are in charge of your own pension. If you don't manage it, nobody else is going to. You're probably also being asked to be your family's chief financial officer, and maybe even the chief financial officer of your business. And this is without any MBA. This is without any sort of training. Maybe you got an hour from somebody trying to sell you a whole life insurance and residency, but that's about it. For most of us, we got almost nothing, maybe not even a session on how to manage our student loans from our medical school. Physicians should become wealthy by virtue of their high income. Our incomes put us in the top 2 to 5%, many of us in the top 1% in the United States, which is one of the wealthiest countries in the world. But becoming wealthy is different from having a high income. Wealth is what you have when it's all said and done. Income is just what's coming in. If just as much as is coming in is going out, you're not building any wealth. But this process of turning that high income into a high amount of wealth, a high net worth, is relatively simple, but it's not automatic. There are a few things that you have to do as you go along. And as you can see, many doctors are doing those things, but there are also plenty that are not. Take a look at this survey. This is from the 2019 Medscape Net Worth Survey. And I want you to focus in on the doctors in their 60s. Okay, if you will look at that, look at the red line. These are the doctors that are not yet millionaires. This is their net worth, remember. This is everything they own minus everything they owe. Okay, it's all their retirement accounts, it's all their investments, it's their bank accounts, their checking account, the value of their house, their cars, their stuff, minus any liabilities they have. You know, mortgage, student loans, credit card debt, whatever. That's what a net worth is. And in their 60s, after 20, 30, 40 years of physician level incomes, they are still not millionaires, right? They might have been making $200,000 or $300,000 a year for 30 years. They might have made $10 million and they have less than $1 million to show for it. And that's a tragedy I want to see eliminated. If you look at what doctors are making, they stack up in the usual way according to the averages, right? You see pediatrics and preventive medicine, family medicine, and endocrinology at the bottom. See orthopedics and plastic surgery and ENT and cardiology at the top. This shouldn't be a mystery to any of us who are paying attention in medical school and residency. What's always amazed me, though, is that the intra-specialty pay differences are even more dramatic than the inter-specialty pay averages. I've met pediatricians that had a 5-figure income. I've met pediatricians that have a 7-figure income, and it just varies. But that's always amazed me. Here's the 2020 net worth survey. You'll see that among all physicians, this is not just retired physicians, you'll see that 50% of them are not millionaires still, and only 8% have more than $5 million. If you look at who's worth over $5 million, it stacks up about like the incomes do. Obviously, higher income makes it easier to build net worth, a theme we'll return to several times today. All right, this is interesting. They asked them, how much do you put into a tax-deferred retirement or college savings account each month? And you'll see that most doctors are putting in, a significant number of doctors. I shouldn't say most doctors, but look at this. It's got to add up to 52% are basically not putting a significant amount of money into a tax-deferred retirement or college savings account each month. This is why we're not building wealth. We're not putting any money away. We're just not saving anything. And this is, again, a non-retirement investing account. And again, you see the same thing. People just aren't putting much money into it. A full 29% aren't putting anything into a taxable account on a regular basis. So you've got this second job. You got to spend some time learning about it. You have to spend some time to learn the terminology, right? It's not as complicated as medicine, but you do have to learn it. You got to know the difference between a Roth IRA and a 401k, and how interest works, and how a mutual fund works, and how your debt works, and what a credit score is, and all this stuff. So I recommend you get an initial financial education. You can get that from books. You can get that from online courses like the White Coat Investors Fire Your Financial Advisor online course. You can hire a financial planner to draft it up and draft up a financial plan and teach you this stuff. But I recommend that you do that relatively early in your career. Residency is a great time. As you come out of residency is a great time. But even if you're not learning it till you're 50, it's still better to learn it now than later. And then, of course, continue to learn as you go along. I recommend you follow a blog or two. I'm a little bit partial to my own, but there are lots of good blogs out there, and that you read a good financial book each year. In fact, the first financial book you read might be worth a couple $1 million to you. It really can be very, very valuable when you take that knowledge and you apply it to a physician income. Anytime you hire a professional, hire them to teach you, not just to do it for you, and be sure to spend the time you need to take care of your business. We all want to be 100% clinical, but the truth is you can't be 100% clinical and be financially successful. You have to pay some attention to the business side. All right, let's talk a little bit about both offense and defense. And what I mean by that is when we're talking about finances, offense is your earning ability. Okay, the ability to earn money, to earn more money, etc. Defense is the ability to spend less money. And when you're using both of them together, it allows you to build wealth a lot faster. Defense, of course, is the most important, just like in football, because you can always spend everything you make, no matter how much you're making. But the key to building wealth is really pretty simple. If you make a lot of money and you just spend a little bit of it, and you put the difference between those two to work, and you make sure you don't lose your money to death and disability and divorce and these sorts of financial catastrophes, you insure against them and protect against them as best you can, then you're going to be wealthy. It's that simple. But remember that you can always outspend your ability to earn. So earning more, working that extra shift, picking up more call, it helps in the short term, but it is not a long-term solution. You can always outspend it. Okay, defense might get all the press in the personal finance literature, but the truth is that offense works too. It is simply more effective to work an extra shift and make $1,000, $1,500, $2,000, $3,000, whatever a shift pays you, than it is to wash out your Ziplocs and reuse your paper towels. It just works a lot better. It's just, you can earn enough money that you don't have to, cut back on your lattes to make money. Yes, you have to pay attention to the big things in your life, the cost of your housing and the cost of your transportation, the cost of your vacations, how much you're paying in taxes, those things, but you don't have to worry about every little latte or pizza you buy. You're a physician and you're making good money and you don't have to worry about that. But if you earn more money, it is easier to save. It is much easier to pay off debt. For example, if you have $200,000 in student loans, it's a little bit hard to pay that off if you're making $150,000 a year. It is not hard at all to pay that off if you're making $400,000 per year. And so the more you can earn, the easier it is to take care of debt and to save money. Even if you're only saving the same percentage of money, it's more money. You can also have some passive income. money you're not working for. At least maybe you worked up front, but down the road, you're not working as hard for as you are your clinical income. Real estate's maybe the classic one, but there are other investments, books, websites, and things like that can also provide some passive income. Some of these shift-based specialties like emergency medicine, anesthesia, tend to be good specialties for entrepreneurs. I think EM's probably the best one because when you work shifts, they tend to be on nights, weekends, evenings, and holidays. And so it leaves you banker's hours when the business world is open to do whatever your entrepreneurial pursuit might be. Just be careful when you start looking for passive income and side gigs. Be careful not to trade your time for less money. This happens a lot to docs. I saw a survey a couple days ago. I think this was a Medscape survey too, where they basically surveyed doctors about side gigs. And the average physician in their side gig made $35,000 a year. And if the average physician income is $275,000 a year, you can see that you don't want to be spending half your time on a side gig that's paying you $35,000 a year. So there's active income. We talked about passive income. Active income is working more shifts. It's taking a job that pays more. For example, I knew a doc that moved from California to Texas, and not only did their cost of living go down dramatically, their state income taxes go away completely, but they were earning 50% more money as well. And so sometimes that geographic arbitrage is the solution to your financial woes. You simply can make a lot more money and spend a lot less money. Taking a second job is another form of active income. You just got to remember when you're doing active income is you got to balance those income needs with burnout because we all have a limit. And once we work too much, we're just going to be too burned out. And we've basically shot ourselves in the foot with a short career that's not going to be good for us financially in the long run. Okay, so this talk's sponsored by Locumstory.com. So I got to say something nice about Locum Tenens, right? Locum Tenens is basically going out and doing work for a short period of time. And it might be 2 weeks, it might be 6 months, but you can use it in a lot of different ways. Some people, it's their main job coming right out of residency. You might have heard of Dahle. He writes a blog called The Physician on Fire. This is what he did for 2 years coming out of residency. He did locums, and that actually helped him find his main job. He figured out what he wanted out of a job, and he found his main job. They hired him after he'd been a locum there for a while. But for most people, it's kind of a moonlighting gig for extra money, right? You get more hours, and often the hours pay better than your main gig. But other people do it for a change of pace. They might want a faster pace, they might want a slower pace, they want to see trauma patients, or they might not want to see trauma patients. Whatever, it's a change from your routine and also can help you to fight burnout. And then, of course, other people do it as a sabbatical, right? They go to New Zealand for a year or something like that, and really have a dramatic change in their practice. So you can do something exotic, Alaska, Hawaii, New Zealand, whatever. You can use it if you happen to lose your contract. Maybe your job goes away all of a sudden, and it's a good way to get work right away. You can often get emergency credentialing and emergency licensing surprisingly fast within just a couple of months. You can also control your hours, right? You can tell the locums company that I don't want to work weekends or holidays or nights. Here's when I'm available. And if they can use you, they can use you. And then, of course, it's also a fun way to travel and just see some new parts of the country and of the world. All right, let's talk about a written financial plan. Here's a picture from a slot canyon. I'm not sure which one this is. I think this is one in southern Utah called Kaleidoscope, I believe is what canyon this is, but just a beautiful, cold, but beautiful place. All right, 90% of the investing questions I get are best answered with this question. What does your written plan say you should do in this situation? And the answer I usually get to that question is, I don't actually have a written plan. Well, the truth is you need a plan. If you don't have any sort of written financial plan, that should be a big focus of the time you're putting into your finances for the next month. There's really 3 ways to get one. One is to read books, ask questions on good internet financial forums, and write it yourself. Okay, this is what I did. In residency, I self-educated, became financially literate. I wrote my own financial plan. It is definitely the cheapest way to do it. It is also the most time-consuming way to do it. A middle ground approach is to take an online course. My course is called Fire Your Financial Advisor, and it's designed so that you leave the course with a written financial plan in place. It's about an 8-hour course. It's all video and some worksheets, and takes you by the hand, walks you through it, helps you write your own plan. Now, that's obviously more expensive than doing it yourself by checking out books from the library, but it's also less time consuming. Now, the most expensive way is to hire a financial planner, but it's also the way that requires the least amount of time and expertise and effort. And so a lot of people choose to hire a financial planner to do that. So here's an example of how a plan helps. Consider last March, right? You remember the pandemic hit. We all of a sudden didn't have any work, right? Those of us doing elective procedures, all of a sudden those elective procedures all went away. Those of us who are in essential specialties, all of a sudden our volumes dropped. In emergency medicine, it dropped by 40% across the country. And at the same time, our investments in the stock market plummeted by 35% in 1 month. And so there were all these questions that people would have. Should we sell our stock mutual funds? Should we use our cash to buy more? Should we trade our bonds for more stocks? Should we trade our stocks for gold or Bitcoin? And the answer is, what does the written plan say we will do when the stock market drops 35%? And the truth is, you're going to go through a number of episodes of the stock market dropping 20, 30, 40, 50% during your investing career. Your investing career, 30 years while you're working, maybe 30 years in retirement, and 60 years. On average, a bear market, which is a stock market drop of 20% or more, happens about once every 3 years on average. And so you should expect to go through about 20 of these during your investing career. And so it's not an unforeseen event you need to react to. It's something you should have planned for. You should have a plan of what you're going to do when the stock market drops 35%. And so our plan, which I think was last revised way back in 2007, said we'll not panic and sell securities due to market corrections. Instead, we'll rebalance our asset allocation. And if we want to change this personal investing statement or this investing plan, we got to wait 3 months before we change it. And so that kept us from panicking, kept us from selling low. And what happened? Well, here's the rest of the story. If you look on here, you will see that at the March 2020, the market was down 35%. But if you just didn't sell, you recovered all your money within a few months. And if you continued to not sell into 2021, you're way above where you were. You made a killing. And that's how a written financial plan helps. It helps to enforce your investing discipline at those times when the market goes crazy. All right, let's talk about the bad news and the good news of physician retirement. Here's a picture of my daughter. She's actually quite a bit older in this picture now, but still gives me that look quite frequently. Okay, let's talk about the Trinity study for a minute. This is a study that came out of Trinity University. This is a university in Texas, and there was 3 researchers, and they basically wanted to answer this question. How much money can you withdraw from your portfolio, adjusting that withdrawal amount upward with inflation each year, and actually have the money last throughout a 30-year retirement? And the reason this was an important study was because advisors used to say, if your investments make 6% or 8% or 10%, you can take out 6% or 8% or 10% a year and spend it. And the problem with that is what's called sequence of returns. For example, if you retire and that year you retire, there's a terrible, nasty bear market and the market falls by 40%, and you're withdrawing from your portfolio at the same time to live, you end up, despite having good average returns over a 30-year time period, because the bad returns came early, you end up running out of money. And because of that problem, the sequence of returns problem, you cannot take out 6 or 8 or 10% of your portfolio a year, even if that's what it earns on average. It turns out the amount you can take out is about 4% a year. And from that came what people call the 4% rule. It probably ought to be called the 4% suggestion, but it works most of the time. In fact, on average, if you only take out 4% of your portfolio over a 30-year retirement, on average, you're left with 2.7 times the amount of money you retired with. And so if you don't have nasty returns show up in the first 5 years or so of your retirement, you can probably spend a little more than 4%. That's the good news. But the bad news is 4% is not that big of a number. Here is the money table from that study. This is their table 2, and it's a complicated table. I know I just threw a bunch of figures up on the screen. So I'm going to leave them there for a minute because I want to walk through them. Okay, if you go down the x-axis, you'll see they divide the categories up by percentage of stocks and bonds in the portfolio. Okay, this is your asset allocation or mix of investments. And they also divide them up by the number of years the retirement period lasts. And if you go across at the top, across the y-axis, or I guess that's the x-axis, going down to be the y-axis, you see the withdrawal rates from the portfolio that you can use each year. So let's go down to a portfolio that's 50% stocks, 50% bonds, and let's look at the 30-year line. You will see if you only take 3% of that out a year, again, adjusted up each year with inflation, that's going to last throughout a 30-year retirement 100% of the time. Okay, it's very, very safe. If you increase that to 4% a year, it's still very, very safe. 96% of the time, 19 out of 20 times, you're not going to run out of money in that 30 years. But if you go to 5%, it falls to about 67%. So about a third of the time you're going to run out of money. If you go to 6%, it runs out of money about half the time. If you go to 7%, it runs out of money about 3/4 of the time. At 8%, it runs out of money 90% of the time. And so that's why you can't take 6 or 8% out of your portfolio every year. You can only take out something like 4% because of this sequence of returns risk. So if you take that number, that 4% number, and you extrapolate it into how big of a portfolio you need in order to be financially independent, in order to retire, if you divide what you spend each year by 4%, or effectively multiply it by 25, that'll tell you how much you need to retire. So if you need to spend $100,000 a year from your portfolio, you need a portfolio of $2.5 million. If you need to spend $200,000, you need a portfolio of $5 million. If you want to spend $300,000, you need a portfolio of $7.5 million. And those are big numbers. And that is the bad news of physician retirement. So let's talk about the good news of physician retirement. Okay, we talked about that 4% rule. If you need $250,000 a year, you need $6.25 million in that portfolio. And that's pretty crazy, right? Because with a 5% real return, a 5% after inflation return, you got to put away 50% of your gross income for 25 years to get that. So the good news is chances are you don't need $250,000 from your portfolio in order to maintain your standard of living. Most doctors do not need to replace 100% of their pre-retirement income. They usually need to replace something more like 25 to 50%. Let me explain why. Let's take this budget. Okay, on the left column, we've got a working physician. On the right column, we've got a retired physician. Okay, look at all the stuff a working physician has to pay for that they don't have to pay for once they're retired. Okay, consider taxes, right? It's not unusual at all for a physician to pay 25% of their gross income in taxes. But that goes down dramatically in retirement, right? Not only do you not have to pay Social Security or Medicare tax at all, because of the progressive nature of our tax system, you're often in a much lower bracket, and some of your retirement assets aren't fully taxed, and so you end up paying a lot less in taxes. That could drop from something like $75,000 to $12,000. Once you're retired, you don't have to save for retirement anymore. Now, I typically tell doctors they should be saving 20% of their gross income for retirement. So for a doc making $300,000, that's $60,000 a year. Well, that expense goes away completely in retirement. You don't have to recreate that. Same thing with a mortgage. If you'll pay off your mortgage before you retire, you don't have to pay for that in retirement. College savings, same thing. By the time you retire, hopefully the kids are through college. Any work expenses you have obviously go away. Hopefully the children are out of the house if you're not letting them live in the basement and play video games. Your life and disability insurance you no longer need because you're financially independent. Healthcare costs might go up a little bit, but you're no longer funding an HSA. If anything, you're spending from an HSA. You're probably giving less money to charity. Maybe you're spending a little less money on transportation because you're not commuting. You're probably spending more money on travel. And of course, you have some other expenses that are going to be about the same. And everybody's going to be different. If you do this exercise, your budget's going to look different than my budget. But if you will do that, you will likely find that the total amount of money you need from your portfolio is dramatically less than your total gross income during your working years. In this case, the retired physician, this doc is getting $45,000 a year from Social Security. So all they need to maintain the exact same lifestyle they had before retirement is about $47,000 from the portfolio. Okay, and how big of a portfolio do you need to get $47,000? Well, just over $1 million. Right? 1.2 or something like that will provide that amount of retirement income. And that's relatively easy for a doctor to reach. 6.5 million is tough. 1.2 million is not that tough. So if you only need to replace 25%, that's good news. For example, if you need to get $75,000 out of your portfolio, multiply that by 25, that's only 1.88 million, very reachable on a physician income. To get there, you'd need to save for 25 years. If you earn a 5% after inflation return, you'd only need to save 14% of your gross income to get there. That's way more doable than 50%. If you want to run numbers like these, I recommend you open up a spreadsheet in Excel or in Google Sheets, something like that, and use their future value function. It's a fun little function to learn, and it's basically the equivalent of a financial calculator. And you can change the variables like how long you save or how much you put in or how much you have now and how much your return is each year, and it'll spit out how much you'll have in the end. And you can do a lot of your own financial planning just using simple calculations available to you in the spreadsheet that's already on your computer. All right, let's talk a little bit about what I call the White Coat Investor Wealth Plan. Now, this is the White Coat Investor family. This is my kids and my wife and I up in Canada. We went to Banff. Wish we could go back, but so far Canada's been closed to us. But that's really is the color of the water up there, thanks to the glacial silt. It's that beautiful turquoise blue. All right, here's the four most important words in this talk. Live like a resident. And this is really the secret to becoming wealthy as a physician. If I can get doctors to live a lifestyle the same as, or maybe just a little bit better than what they lived as a resident or fellow for 2 to 5 years after they come out of training, it will solve all of their other financial problems for the rest of their lives. Let me explain how this works, okay? Let's say you make $60,000 a year as a resident these days. 55, 60,000 is what residents are making. And then you become an attending and you're making $200, $300, $400,000. Let's say $300,000. There's a difference between $60,000 and $300,000 of $240,000. Now, maybe another 60 of that's going to go to taxes, but that still leaves you a $180,000 difference that you can use to build wealth if you will just not spend it. You can use that to pay off student loans, right? Imagine you're throwing $15,000 a month at your student loans. How long are they going to last? Not very long, just a year or two for most docs. You can use it to jumpstart your retirement savings. You can save up a down payment on your dream house. You can probably do all three of those in less than 5 years by living like a resident. In fact, you don't even have to live like a resident. Give yourself a raise. Give yourself a 25% raise. That would be huge in the corporate world. Instead of spending $60,000, spend $75,000. Still gives you plenty of income with which to build wealth, and you get to feel like you have a little better lifestyle than you had as a resident. But if you'll do that for just a few years, after your live like a resident period is over, you can then grow into most of your attending income. I say most of because you still need to save 20% of your gross for retirement. But you can have a very nice life on 80% of what a physician earns. Okay, so that's step 2. So grow into your income. If you're an emergency doc like me, you'll probably never get a raise, right? Maybe when you make partner in a small democratic group after 2 or 3 years, you'll get a raise, but that's it. Basically, your income's flat after that. And for lots of docs, that's the way it is. If you're not building a practice, that's probably what your income is going to look like. And just remember that it's really hard to decrease your lifestyle. It's hard to cut back from taking nice vacations in Europe. It's hard to cut back from driving a Tesla. All right. It's hard to cut back from flying first class. And so try not to increase that. Or if you're going to increase your lifestyle, try to do it very slowly. Okay. Step 3 is to maintain your plan, right? Continue to put 20% of your gross income toward retirement. Max out those retirement accounts, 401ks, 403bs, 457bs. If you're self-employed, solo 401ks. If you're a partner, your partnership probably has a 401k profit sharing plan. Maybe it has a defined benefit plan. You can do a personal and a spousal backdoor Roth IRA each year. You may have a health savings account available to you. All these retirement accounts, max them out. And if you're like most docs, you still are going to have to save something above and beyond that in a taxable or a non-retirement, a non-qualified account in order to get to that 20% number. Then put most of your investments into index funds. Okay, index funds are low cost, broadly diversified. They are a smart way to invest. Okay, you can buy all the stocks in the world in 30 seconds by buying an index fund, and it's going to outperform the vast majority of investors over the course of your investing lifetime, particularly after tax. Okay, if you want to spice it up a little bit on the side, you want to put a 2% into Bitcoin, that's fine. If you want to, branch out into some real estate, you want to own properties directly and be a real estate mogul, that's fine. Just, build it on a solid base of index mutual funds. And then make sure you follow your written plan, especially during bear markets. Don't bail out when the stock market drops. Make sure you play both offense and defense throughout your career. Boost your active income, boost your passive income. Try to avoid buying stuff you can't afford. And the easiest way to tell if you can afford something is whether you can pay cash for it. If you have to make payments on it, you can't afford it. Whether that's a car, whether that's a vacation home, whatever it might be, right? If you find yourself with 12 different sets of payments you have to make each month, that's going to really hold you back from building wealth. Incidentally, if you've never seen the skit on Saturday Night Live with Steve Martin called Don't Buy Stuff You Cannot Afford, when this presentation's over, go Google that. It's a hilarious skit, but it really drives in my point on this. Okay, step 4 is when you win the game, stop playing. Okay, when you find out you have enough, which usually comes at the height of a bull market, pay off your mortgage. Don't take risks you don't need to take. If you don't need that leverage risk, don't take it. Okay, you can actually be done saving for retirement and college. Some people call that coast FI because their portfolio will get to the point by the time they retire that they have enough without ever adding anything to it, just from portfolio growth. You don't have to save your whole life for retirement if you can be done saving for retirement by mid-career. And then you can figure out what you want out of your life. Maybe it's fewer shifts like it was for me. Maybe it's dropping night shifts like it was for me. But for you, it might be something else. Maybe it'll allow you to pursue some professional or academic or lifestyle pursuits that you're interested in. Or if you look at the happiness literature, you'll realize that shared experiences with people that you care about are the most important thing to bring happiness into your life. And when you have the money to do that, you can have a lot more of those. For example, I just got back from spending a week with my family in Boundary Waters in Minnesota. We were canoeing up there from lake to lake and just spending time together. And those are the things they're going to remember. Those are the things I'm going to remember. But you can have a whole lot more of them when you have your financial ducks in a row. All right, so what have we learned today? Well, we've learned that your finances do actually affect your health. We've learned that financial literacy and discipline is a key component of preventing and treating burnout. It's not everything, right? A lot of burnout is a toxic job, a terrible system that needs to be fixed. Part of it is, our own personal resiliency. But financial literacy and discipline has a part to play in it because it allows you to do so many other things that can help treat that burnout. We learned that it's important to become financially literate. If you are both financially literate and disciplined, it's like having a superpower. It is so rare in our society that you look around and you wonder why more people aren't doing what you're doing. And you realize it's just because they don't know. They don't know and they don't have the discipline to become, not necessarily wealthy, but certainly comfortable and financially independent. Learn the importance of boosting income and spending carefully, the importance of a written financial plan, not only to help guide your finances, but also to help burnout. We learned that you need 25 times your spending to retire, but you can probably maintain your lifestyle in retirement with 25 to 50% of your current income. And we learned that it's simple, but not necessarily easy to become rich as a doctor. All right, so we're going to take as many questions as we can. I think we've got about 15 minutes. If we don't get to your questions, you can send them to me by email, editor@whitecoatinvestor.com. You can come by the website. We've got podcasts and video casts and online courses and conferences, however you like to learn, whether it's by emails or by reading blogs or by following us on social media. We've tried to put this information into the format that you prefer. And that's all found at whitecoatinvestor.com. Thanks again to locumstory.com for sponsoring this talk. And let's get into some of your questions and we'll spend as much time on them as we can.
Great, thank you so much. Great information. I know I've learned a lot and I'm sure all of you have as well. We did have a few questions come in. If you're for all you attendees, throw your questions in the chat and we'll get to them. Here are a couple. Let's see, I get overwhelmed when I think about creating a financial plan. What's the easiest way to start? And also, do you recommend any programs to manage finances or gauge for retirement?
Sure, let's take the first one of those. The best place to start is to figure out where you are. No kidding. Figure out where you are. Take everything you own and its value and write it down. Now, I'm not talking about your sweaters, right? I'm talking about your checking account, your savings account, any investments you might have, your retirement account. If you own a home, the value of your home, write it down on the left side of a piece of paper. Total it up, okay? Those are your total assets. And then on the right-hand side of the paper, I want you to write down every debt you have. Okay, pull up the websites for your credit cards, pull up your auto loan, pull up your student loans, every one of them, write them down, write down how much you owe on it, what the monthly payment is, what the interest rate is on it. If you have mortgage, or any, rental properties with mortgages, put all those down on the right. Okay, total them up. Those are your total liabilities. Now subtract your liabilities from your assets, and that's your net worth. And I think that is a great place to start. And I think you ought to do that every year. Actually add up your net worth and compare it to how you did the previous year. Are you making progress? Most docs, when they come out of training, they've got a negative net worth, minus 200, minus 300,000, something like that. But those who concentrate on it and measure it every year, they find that they go to the positive pretty quickly. It's a wonderful thing. You should definitely celebrate when you get back to broke. But you should, then start rapidly building wealth beyond there. So that's important. The other thing you ought to do, and any business would do this as well, they'd figure out not only their balance sheet, which is like your assets and liabilities, but they would figure out their income sheet, which is everything they got coming in and everything they got going out. So all your sources of income, right? Write these down on the left side of a sheet of paper. Your salary, any side gigs you might have, any investment income you might have, any money your parents are sending you, whatever, right? Put all that on the left side of a sheet, and on the right side, put everything you're spending money on. If you have no idea where your money's going, go open up your bank account and see what you spent money on last month and the month before, and pull up all your credit cards and see what you spent money on, and put that all there. And this is then essentially the beginning of a budget. And look at your money, see where it's going. Is it going to those things that you care about? If it is, great. If you're saving enough, if you're saving that 20% of gross toward retirement, wonderful for you. Some people do that automatically without even trying. But most people, when they do this exercise, they'll realize their savings rate is 3% or 7% or some inadequate number. And then they got to look at those things and realize, what do I care about less than financial independence? And they got to start cutting back on those things they care about less than that. And so that's basically the budgeting process. So once you know where you're at and you know what your resources are to pour money into going forward, then you tend to move toward other things like a student loan plan, how you're going to manage your student loans, an insurance plan, how you're going to protect yourself from death and disability and liability and those sorts of things, and an investing plan, what investment accounts you're going to use, what investments you're going to put into them, etc. And believe it or not, that's the part that overwhelms so many people. And it's actually the simplest part of the whole thing. You can find a very simple yet effective investing plan that's tax efficient and easy to follow through the years. And so I walk you through that in my course. I walk you through that in about every blog and book I've ever written. So if you need more details on that, feel free to come by whitecoatinvestor.com or shoot me an email.
Thank you. All right, here's an interesting one. Have you found that your advocacy efforts for physician finance education have borne fruit with medical schools? Is there more formal education in schools because of your work? And also, have whole life insurance sales gone down?
Well, there were 0 schools teaching financial literacy when I started in 2011. There are now 5 or 6 that have a formal curriculum in place. And there are probably another 25 or 30 that I know of where lectures are at least being given, 2 or 3 lectures a year are being given in the schools or in the residency programs. So it's not certainly an overwhelming change, but we're making progress. And I'm convinced that as we continue to focus on it and teach doctors about this stuff, that we'll see it more and more in medical schools for sure. As far as the whole life insurance folks, I think I'm winning, and I'll tell you why. Northwestern Mutual, which is the one that's most notorious for selling policies to doctors that they don't need, actually sent out a tutorial to their agents a couple of years ago that basically walked through the material I had, pointing out the problems with whole life insurance, and gave the agents answers to give to people who brought them up. So I think I am affecting their bottom line a little bit, probably not all that much though. They're a pretty big company, and I think they're doing just fine.
All right, let's see. I think I know how you're going to answer this one. Any books or course recommendations? You said you encourage everyone to read a financial book each year.
Yeah, I mean, I like the courses we put together, obviously. I like the books I've written, but there are other good books out there. I keep a list of good books by others on the website. If you go to the menu at the top of the White Coat Investor, you can click on that, and I've probably got a list of about 40 books, all of which I think are worthwhile reading. I have starred about 4 or 5 of them that I think are the best ones. And for your initial financial education, I think what you're looking for is a basic personal finance book, a basic investing book, a behavioral finance book that really helps you get some insight into the behavioral errors and mindset problems that investors have. And then a physician specific book, something like the White Coat Investor. And if you will read one of each of those books, you will know more than 99% of your peers and the majority of people who call themselves financial advisors. It's really amazing in the financial advisory world. So many of them are just commission salesmen. They're not actually trained in any sort of finance. And so it doesn't take that much learning to get beyond a surprising number of them.
Thank you. Let's see. Have you found that most doctors have higher risk tolerance when it comes to investing? Maybe because docs have high and usually stable income, or are they more conservative? What is the worst, most common behavioral finance error for physician investors?
Boy, those are a lot of good questions. I used to think about physician incomes as being very stable. I think a lot of us did until March 2020. And now it doesn't feel so stable at all. A lot of people had their incomes go down dramatically. For example, volumes in the emergency departments across the country dropped 40%. That doesn't mean your income drops by 40% because there's still the same amount of overhead, right? So that means incomes might have dropped by 50 or 60% if you owned your own practice. And it was worse for some specialties. Imagine you were a hip replacement orthopedist, right? That's all you do is hips and knees or something. All of those were canceled for 2 months last spring. And so, your income's not maybe as stable as you think it is, number one. But is it more stable than lots of people's income? Sure, it probably is. And so that does allow you to take on more investment risk in your life. It allows you to take on more entrepreneurial risk. If you're starting a company and you're still able to practice while you're starting it, that gives you a long, long runway to get that company off the ground. But does that necessarily mean that you can tolerate it in a bear market? I think it really depends on the person. Part of it is education. A lot of people just don't understand that the stock market drops 20% plus every 3 years. If you understood that that was normal behavior, you wouldn't feel like you got to panic and sell out every time it happens. But part of it is just our innate natures. Some of us have a stomach of iron and we don't lie awake at night worrying about our money, while others of us, it's a big deal to us watching the volatility of our investments. And if it's a big deal to you, educate yourself as much as you can, but you probably need a less aggressive portfolio, a less aggressive mix of investments, what we call an asset allocation. And so I think that's, you just have to know yourself. And sometimes you can't know yourself until you've invested through a bear market. The other part of that question was, what are common behavioral pitfalls that docs fall into? And I think the most common one is the same one everybody falls into, whether they're a doctor or not. They just spend too much of their money. If you're not carving out enough of your income to build wealth, you're never going to be wealthy. Truly, I saw something the other day, and it basically said, if you will save $500,000 a month starting when you're 25, you'll end up with $500,000. And their point was, you're a lot better off starting at 25 than you are 35. But the message I took from it was, if you only put $500 a month in there, you're never going to have more than $500,000. And so you got to put more than that. And so that's the message I would give as the biggest behavioral finance issue the doctors have, is they just don't save enough. But others are also very common. One is we tend to collect investments rather than having some sort of underlying plan and goal for our investments, a target asset allocation, if you will. We just collect this hodgepodge of investments. We got a little Bitcoin here. We got a few random stocks here. We got a couple of bonds here. We got our brother-in-law's business here. We got a real estate property here. And there's no plan. There's no underlying theory behind our portfolio. And so I think that's a big problem. You got to put an underlying plan in place. And then I think another issue we have is we become overconfident at our ability to predict the future. And if you think you can predict the future, whether it's interest rates or whether it's the return of investments or whatever it might be, I would encourage you to try to do so. Keep a journal, and actually every time you have a prediction, be specific and write it down. And what I suspect will happen is that within a year or two, you will convince yourself that your crystal ball is just as cloudy as mine is, and you'll quit trying to predict the future. And what that allows you to do is it allows you to invest in a way that's much less stressful, because you invest in a way that you're likely to be successful no matter what happens in the future. You tend to broadly diversify instead of just picking the stocks that you think are going to do great. You just buy all the stocks, and it's a much more likely to be successful process that you do when that is where you start from.
Thank you. I think this one was submitted before you got to this slide, kind of going through some of this, but maybe it's a good refresher. It says, what are the best accounts to invest in, 401k, Roth, or just general investing?
Well, I mean, in general, if you can get an account that's going to protect you from taxes and protect those assets from your creditors, that's where you want to invest first until you max them out. And those in general are your retirement accounts. Okay, so you've got an IRA available to you. Everybody earning money can put money into an IRA. Now, for most doctors, the process they go through is called a backdoor Roth IRA, where they first put it in a traditional IRA and then move it to a Roth IRA. You can do that for you and your spouse. That money will never be taxed again. It's tax-free. All the gains are tax-free. That money is protected from your creditors in most states. It's a great place to invest. Likewise, your employer likely offers some investing accounts, some retirement accounts. Depending on the employer, it might be a 401k or a 403b. Maybe there's a 457 or a defined benefit plan in addition to that. But learn what your employer has to offer. Go to HR. If you ask them, they have to give you the plan document. And you can learn all about those accounts and the investments available in them and the fees in them. And you can learn about those things and use them to max them out. But once you've maxed out all those tax advantage accounts, you know, your retirement accounts, your health savings account, if you're saving for college at 529, then at that point, you just have to invest in a regular old taxable brokerage account. And you can put an unlimited amount of money into that. It does get some tax benefits. You can take it out and use it for whatever you want, whenever you want. So it's a very flexible account, but it's not quite as good as a retirement account. And so generally you max out your retirement accounts first, and then you go to a taxable account.
Great. One last question. We're about at time, but we'll throw in one more question. I was a partner in a financially successful private practice, yet had little knowledge and had poor personal finance habits and bought whole life insurance. Do you find this common among docs? Why do you think that one doesn't lead to the other?
Yes, it's very common among docs. I mean, I owned a whole life insurance policy for 7 years, and then I sold it at a loss. I had a 33% loss on it after 7 years, and that's not uncommon at all among doctors. But it's interesting because the decision of whether to keep a whole life insurance policy is different from the decision of whether to buy it in the first place or not. Because the terrible returns on it are heavily front-loaded, sometimes it can make sense to keep a policy you've had for 10 or 15 years, even if it didn't actually make sense for you to buy it in the first place. So if you're in that situation, I would encourage you to get the policy evaluated, really get an in-force illustration, calculate your return on it going forward, calculate your need for insurance going forward, and then make an informed decision about whether to keep it. But yeah, I would say a lot of doctors have made that mistake. And, you know, the truth is a whole life insurance policy is probably only appropriate for about 1% of doctors. So unfortunately, that is also a common mistake we make.
Great, thank you. I think that's about it. We're at time. Thanks again for everyone who attended today with us. And thank you so much, Dr. Dahle. These are always super informational and educational. And we hopefully will see you again soon. Hopefully we can get out and do some in-person events at some upcoming conferences. That's always a good time when we haven't done that for quite a while. We'll be doing these webinars every few weeks, so check back on our social feeds, or check your email if you're on our newsletter. And we have some great topics coming up. Thanks again to everyone. If you have any questions, check out locumstory.com.